Imagine arriving at one of the world's most respected airlines, only to discover your aircraft isn't going anywhere. The crew is ready, passengers are seated, the engines could start at any moment, but the airline can't afford the fuel. On 2nd October 2001, Swissair, the airline that had represented Swiss precision, reliability, and national pride for decades, grounded almost its entire fleet. Thousands of passengers were stranded. Aircraft remained parked across Europe. One of aviation's most admired brands had effectively stopped flying overnight. The collapse shocked the industry, because Swissair wasn't known for poor service. It wasn't known for unsafe aircraft. It wasn't losing customers to inferior competitors. For decades, it had been considered one of the world's finest airlines. Founded in 1931, Swissair grew into the national carrier of Switzerland, earning an international reputation for punctuality, premium service, financial discipline, and operational excellence. Business travelers trusted it. Governments respected it. Its distinctive red and white aircraft became one of the most recognized symbols of Swiss quality around the world. By the early 1990s, Swissair served destinations across Europe, North America, Asia, Africa, and the Middle East. It carried millions of passengers every year, operated one of Europe's most respected long-haul networks, and consistently ranked among the world's leading international airlines. Inside the aviation industry, Swissair earned a remarkable nickname, the Flying Bank. The company appeared so financially strong, so conservatively managed, and so consistently profitable that many believed it possessed one of the healthiest balance sheets in global aviation. But hidden behind that reputation, Europe's airline industry was changing. Governments were opening markets, competition was accelerating. Large airline alliances were beginning to reshape international travel, and Swissair faced one problem that threatened everything it had built. It was one of the world's strongest airlines, standing outside the new aviation system. The decision it made to solve that problem would eventually leave one of the world's richest airlines unable to keep its aircraft in the air. By the early 1990s, Swissair wasn't facing a financial crisis. It was facing a strategic one. For decades, European aviation had been heavily regulated. Governments controlled which airlines could fly particular routes, how often they could operate, and in many cases, how much they could charge for tickets. National airlines largely competed inside protected markets. But that system was beginning to disappear. The European Union gradually liberalized its aviation market, allowing airlines far greater freedom to operate routes across member countries. Competition intensified almost overnight. At the same time, another transformation was reshaping global aviation: airline alliances. Instead of competing alone, major airlines began cooperating. Imagine flying from Zurich to Sydney. One airline might operate the flight to Singapore. A partner airline would continue to Australia. Passengers could purchase one ticket, check luggage only once, earn frequent flyer points across multiple airlines, and travel through a coordinated international network. For airlines, the advantages were enormous. More destinations without buying more aircraft, higher passenger numbers, shared airport facilities, coordinated schedules, lower operating costs, and greater pricing power against independent competitors. Around Europe, these alliances expanded rapidly. Lufthansa became a founding member of Star Alliance. British Airways strengthened the One World Alliance. Air France developed increasingly powerful international partnerships. Swissair wanted to participate, but there was a major obstacle. Switzerland was not a member of the European Union. Following the 1992 Swiss referendum rejecting membership of the European Economic Area, Swissair suddenly found itself outside many of the aviation freedoms its European competitors increasingly enjoyed. Joining the largest airline groups became far more complicated. Management feared the company would gradually become isolated, surrounded by enormous airline alliances controlling more passengers, more routes, and more international connections every year. Doing nothing no longer seemed like an option. If Swissair couldn't easily join Europe's expanding aviation networks, perhaps it could build one of its own. That decision, known internally as the Hunter strategy, would completely transform the company's future.
Swissair's answer became known as the Hunter strategy. Instead of joining an existing airline alliance, management decided to build its own European aviation network. But rather than purchasing one major airline outright, Swissair followed a different approach. It acquired significant minority stakes in several airlines across Europe. The idea appeared financially efficient. Swissair could influence multiple carriers, expand its route network, share passengers, coordinate schedules, and strengthen its international presence without paying the enormous cost of buying entire airlines. During the second half of the 1990s, Swissair invested heavily in airlines including Belgium's Sabena, France's AOM, Air Liberté, Air Littoral, Germany's LTU, Italy's Volare, and several other European carriers. On paper, the strategy promised enormous advantages. Each airline already possessed aircraft, employees, airport slots, maintenance facilities, and established customer bases. Instead of building entirely new operations, Swissair expected to connect existing airlines into one coordinated European network. Imagine owning several pieces of different railway companies. Individually, each railway covers only part of the country, but together they create one much larger transport system capable of competing against the biggest operators. That was exactly how Swissair viewed its airline investments. But there was one problem. Many of the airlines Swissair invested in weren't financially healthy. Several had already been losing money for years. Weak profitability, high operating costs, intense competition, and inefficient management had already placed significant pressure on their businesses before Swissair arrived. Management believed restructuring, better coordination, shared purchasing, and Swissair's financial strength could gradually return these airlines to profitability. Instead, the opposite began happening. Rather than the weaker airlines becoming financially stronger, Swissair increasingly found itself supporting their growing losses. What began as strategic investments slowly evolved into a network of businesses consuming enormous amounts of cash. What looked like strategic expansion was gradually becoming a financial rescue operation. Many of Swissair's partner airlines continued losing money year after year. Instead of contributing profits to the group, they repeatedly required fresh capital simply to continue operating. Imagine owning several apartment buildings. You expect each property to collect rent and generate income. Instead, every month, each building requires additional cash just to pay its own electricity, maintenance, staff, and repairs. Soon, your profitable properties are no longer creating wealth, they're funding everyone else's losses. Swissair found itself in a remarkably similar position. As losses mounted, management faced an increasingly difficult decision. Stop supporting the airlines and risk watching years of strategic investment collapse, or continue injecting more money, hoping restructuring would eventually succeed. Again and again, Swissair chose to continue supporting them. During the late 1990s, hundreds of millions of Swiss francs flowed into struggling subsidiaries through capital injections, loan guarantees,
operational funding and financial support packages designed to keep the airlines flying while turnaround plans continued. Each individual investment appeared manageable, but together they placed enormous pressure on Swissair's own finances. The company's once famous balance sheet began changing. Cash reserves steadily declined, debt increased, interest expenses grew. Instead of financing Swissair's own future, its financial strength was increasingly being consumed by airlines that still couldn't consistently generate profits. Management believed one more restructuring, one more refinancing, or one more recovery plan might finally stabilize the network. But every delay required more cash. Every additional investment increased financial exposure. The Hunter strategy had quietly crossed an important line. Swissair was no longer investing to build a stronger airline group. It was spending increasing amounts of money simply to prevent parts of the existing network from collapsing. The company still looked powerful from the outside. Passengers continued flying. Aircraft continued departing. The Swissair brand remained respected around the world. But beneath that confidence, the balance sheet supporting the flying bank was becoming weaker every year. The strategy hadn't failed overnight. Its liquidity had been draining away, one capital injection at a time. By 2001, Swissair was already carrying the weight of years of expensive expansion. Its balance sheet was weaker. Its cash reserves had fallen. Its debt had increased. Yet the airline was still operating. Management believed there was still enough time to complete the restructuring, restore profitability, and stabilize the Hunter strategy. Then, everything changed. On 11 September 2001, terrorist attacks in the United States triggered the largest immediate shock the modern airline industry had ever experienced. Almost overnight, passenger confidence collapsed. International travel declined sharply. Business travelers postponed meetings. Companies canceled corporate travel. Aircraft that had once departed full began leaving with hundreds of empty seats. For every airline, less revenue was arriving, but many costs barely changed. Aircraft leases still had to be paid. Pilots still received salaries. Maintenance continued. Airport charges remained. Fuel contracts continued. The cost of operating an airline doesn't disappear simply because fewer passengers buy tickets. For financially healthy airlines, the sudden downturn was painful. For Swissair, it became catastrophic. Years of supporting loss-making subsidiaries had already consumed much of the financial cushion that once protected the company. Now, cash was leaving the business faster than it was arriving. Banks became increasingly reluctant to extend additional credit. Suppliers demanded payment before providing further services. Fuel companies wanted greater financial certainty. Every discussion inside Swissair's headquarters became focused on one question: how much cash remained and how long would it last? Management urgently searched for emergency financing. Negotiations continued with banks, government officials, and potential investors, but confidence was disappearing almost as quickly as liquidity. The problem was no longer profitability, it was survival. Without immediate access to enough working capital, even one of Europe's most respected airlines could no longer continue normal operations. Swissair hadn't been brought down by one event. The Hunter strategy had gradually weakened the company's financial foundation. September 11th simply removed the final support holding the structure together. Within weeks, one of aviation's greatest icons was approaching the moment that would shock the entire world. By the beginning of October 2001, Swissair's crisis had become a race against the clock. Every departing aircraft required immediate payments. Fuel suppliers expected cash. Airport operators demanded settlement. Ground handling companies wanted payment. Aircraft leasing obligations continued. Payroll deadlines approached. The airline wasn't collapsing because passengers had disappeared overnight. It was running out of working capital needed to keep each individual flight operating. Management spent its final days desperately searching for emergency liquidity. Banks, government officials, and corporate partners held continuous negotiations. Everyone understood what was at stake, not just one airline, but Switzerland's national carrier. Yet confidence had fallen so far that providing new financing became increasingly difficult. Potential lenders questioned whether additional money would simply disappear into a business that could no longer recover. Then, on the morning of 2 October 2001, the crisis reached its breaking point. Swissair no longer possessed enough immediately available cash to continue normal flight operations. Fuel suppliers refused further deliveries without payment. Essential service providers demanded financial guarantees before continuing their work. Across Europe, Swissair aircraft remained parked at airport gates. Some flights were canceled before boarding. Others had already boarded passengers, only to remain on the ground because the airline could no longer complete the payments required for departure. Cabin crews, pilots, airport staff, and passengers all experienced the crisis unfolding in real time. One of the world's most respected airlines had not suffered a mechanical failure. Its aircraft were ready, its crews were ready, its passengers were ready. Its balance sheet wasn't. The image shocked the aviation industry. The airline known for Swiss precision had become unable to finance its own daily operations. In the days that followed, the Swiss government, major Swiss banks, and private investors assembled an emergency rescue package to keep essential operations alive while a longer-term solution was developed. That rescue eventually became the foundation for a new airline. But Swissair itself, the company that had once been called the Flying Bank, would never recover. Its aircraft stopped flying not because they couldn't, but because the money keeping them in the air had finally run out. The grounding of Swissair's fleet marked the end of one company, but it did not mark the end of Swiss aviation. Following the emergency rescue, the Swiss government, major Swiss banks, and private investors worked together to preserve the country's international air connections. Rather than attempting to save the heavily indebted Swissair structure, they built something new. Crossair, a smaller regional airline that had remained financially healthier, became the foundation for a new national carrier. Its aircraft, employees, routes, and operational infrastructure were gradually expanded. In 2002, the airline was relaunched as Swiss International Airlines. Many former Swissair employees continued their careers there. Passengers once again flew under a Swiss national airline, but the company behind the famous Swissair name had disappeared forever. Shareholders suffered devastating losses. Many investments became virtually worthless. Thousands of employees faced enormous uncertainty during the transition. Across Europe, the airlines involved in the Hunter strategy continued facing their own financial struggles. Several entered restructuring, changed ownership, or eventually disappeared from the aviation industry altogether. Swissair's collapse also became one of aviation's most important management case studies. It demonstrated that buying market share is not the same as building sustainable profitability. A larger network means little if every new destination requires more cash than it generates. The airline industry also learned another lesson. Growth financed by a strong balance sheet can create enormous opportunities. But once that balance sheet becomes the source of continuous rescue funding, it quietly stops being a competitive advantage. Today, Airline executives continue studying Swissair's rise and fall in business schools, boardrooms, and aviation strategy programs around the world. Not because the company operated poor aircraft, not because passengers stopped trusting its service, but because one of the world's most respected airlines proved that even operational excellence cannot overcome a strategy that continuously consumes more capital than it creates. The aircraft were grounded for one day. The lesson they left behind continues flying through boardrooms around the world.